Friends, thank you all for joining us on this wonderful day. It's 75 years of our country's independence, and we are now celebrating Republic Day as part of a very long celebration, which we call as Azadi Ka Amrit Utsav. I think most of us are very lucky to live in these times when our country is making rapid strides, because it is the progress of our country which is giving us so much of opportunities in wealth creation. Our journeys in wealth creation are closely connected with the economic growth of the country and the opportunities which that growth is throwing towards all of us. Now, capturing these opportunities is the essence of how much we are able to achieve as investors. And there are different ways in which we can capture these opportunities. My personal experience and the experience of those whom I have closely worked with or followed or engaged with is largely centered around spotting things early, capturing opportunities with a long runway in our portfolio, owning them long enough to make a material difference to our investing, and to take advantage of valuations in these opportunities and selling when things are really too good to be true. In that sense, the space which is incomparable in providing those opportunities is the small cap space. And most of the wealth that I have created originates from finding companies which were small caps and which went on to become mid caps. Now, this is not something you can just habitually do. You can't just wake up and do it, but you have to do it over a very long period of time through commitment, through monitoring opportunities, and through following companies so religiously. Because there comes a moment in the life of every company when it is said to do bigger things. And we must make sure that we are invested in that company at that moment. I know a lot of small cap investing in recent times is about finding that moment just before it appears. It's all like buying an air ticket and running into the boarding gate. It's that fast and it's that seamless. But past experience tells us something very different. Often you are too early, you need to have patience, and you should also know that moment when the investment is going to take off. So you can't just buy the ticket and board the flight just before it's going to take off. The mindset which works best to do such small cap investing, where you are a little bit early, but you still are not too early and you're not trying to time it too fine, has to be something like startup investing. You have to know where the business is in its growth cycle and when it's going to have that transformatory moment. So the mindset itself has to be very different. It can't be distracted. It has to have very high concentration, and you have to play like you're in it for a long innings. A comparison which I would always like to give is small cap investing is a lot like regulation test cricket. I know a lot of people are making it appear that it can be played like T20, and the regulation shots in such investing are like reverse sweeps, but the big money is mostly made by batting like or playing like regulation test cricket. So you have to get in a little early, get your eye in, play your shots, and then play your big shots when you're very well settled. So just in time has worked in recent years, but if you take a longer duration, just in time doesn't really work all the time. So there comes a time when just in time stops working. Whereas regulation cricket is something that's all season and it works all the time. Sure that in some market contexts, like the present one or the one in 2018, it appears that a regulation approach doesn't work. But when you extend the time horizon by 2-3 years, you will see that companies which look like boring companies in 2018 went on to become the multi-baggers of 2021. It's quite likely that the same thing can happen even in a difficult year like 2022, and opportunities which we find in this period may become very big winners in 24 or 25. So the approach has to be somewhat like what successful large investors have done in small cap investing. And the example that I would like to throw up is the super success which some of the very established private equity investors in public markets have done. We call it as PIPE, private investing in public markets, where a private equity investor buys up to 10% in a company and he holds on to that company for 4 to 5 years. Sometimes the company does nothing for 1 or 2 years, and then in the third, fourth, and the fifth year, it does a lot. That approach to me seems to be a fail-safe approach, and I have seen quite a few PE investors do it to remarkable success in the last decade. And I believe the next decade is also going to belong to that genre of investing, where we know there are a lot of opportunities. We know some of those opportunities are neglected now and probably will become more and more popular over a year, 2 or 3. And then they will deliver big over year 4 or 5. Serious investors generally are going more after those opportunities. Now, if you look at the results of such investors, it won't be so great. I was quite humbled when in one of my Twitter threads, one such investor said the last 1 year has been very humbling. And he, in my opinion, is one of the best small cap investors in the country. Whereas the kind of small cap investing that we are celebrated in 2021 is very different. But to me, it looks more likely that the genre of investing which he has practiced is probably going to be more successful going forward and more sustainable. That is very, very important as a small cap investor. Success must be sustainable. You should be able to do it over a very long period of time. And that's the only metric I will measure myself against, because I've already spent 31 years doing small cap investing and I want to do it for a longer period of time. So the approach that will work in the long run is to seek sustainability and to seek sustainability in small caps. So what do you need to do that? First, you need the right investment philosophy. Second, you need a consistent process. Third, you need a great team. And lastly, you need the perfect product. And that is where we are now going to present something to you. Any product that I have done in the last decade of being a public market investor, somebody who invests on behalf of others, has come from my own personal conviction, very high conviction, which I have developed. And this conviction has always been developed by putting my skin first in the game. So whether it is a solitaire or whether it's the mutual fund approach or the RA approach, in everything I have believed 100% in what we have done for others. VRDDHI is no different. We have been cultivating and curating this thought process for a long time. It has been tried in my own portfolio for a reasonable period of time. It has weathered 2018 and the last 2 years. And in May 2021, it became a PMS product. So we have come together as a team to take this product forward, run it to a very, very strong investment philosophy, which is backed by a disciplined process in which we back each other, we collaborate, and we bring the best for the product. And that is what we are going to speak about today. I let my two colleagues take you through what we do, how we do it, and what has been our experience. I would like to introduce to you Rohit Balakrishnan and Rajat Setia, and they will now present to you more about VRDDHI, and then we'll come back to the Q&A session. Over to you, Rohit.
Thanks, Ram, for that brilliant introduction. And Good morning, everybody, and thanks again for taking out time on a holiday to spend your time hearing this webinar. As Shyam said, we would probably spend about 25-30 minutes. Rajat and I will take you through the presentation, and then we can do the question and answers. We go into how to really develop conviction, how to really build that process. I'll just spend maybe a couple of minutes talking about the philosophy that we follow at VRDDHI, right? So at VRDDHI, our framework is to really take calibrated approach towards investing in companies, calibrated risk towards investing in small caps. So if we can move to the next slide. So we really focus on keeping things very simple, right? So there are a lot of companies in the small cap, but we want to focus really understand. There may be companies which have a web of subsidiaries, have a very complex way of operating. We try and avoid all that. We focus on the businesses that we understand, right? Most of the businesses that we have in the portfolio, right, today, they are market leaders in what they do. So they may be number 1 or number 2 or number 3 in the area. Why is this important? We had COVID, right? If you are a dominant business, you will come out trumps. You will gain share from others. You will be able to withstand the kind of volatility, the kind of turbulence that the environment threw at you. And you will be able to really gain share from your competitors. So this is why we focus on backing companies which are very, very strong from their market positioning. The second thing that we really focus on is to really stay away from leverage. If you really look at history, then most of the companies that have gone bankrupt, they usually have a lot of debt. So if you look at the portfolio that we have built at VRDDHI, I would say 75% of them are actually debt-free. They have surplus cash. So in that sense, if you don't have debt, then you have one more less reason to go bankrupt, right? So focusing on that aspect is extremely crucial. The fourth point I would say is really focusing on companies which have very strong corporate governance. Again, as I said, if we have the entire gamut of small cap companies, if you just remove the companies which are sort of not following good, they don't have good corporate governance history in the past, then probably that will leave with us the only companies that we need to focus on. So we really try and do a lot of work on understanding the history and also trying to get to this answer that whether this company, whether this management, whether this promoter will be a fair partner with us in the journey that we will invest in. And obviously, when we invest in small caps, we want growth, as Shyam was explaining, that we are lucky to be at that juncture where our country is really at the cusp of taking off. So we have so many opportunities, so we really want to partake in that growth. But at the same time, we need to be really conservative in our approach, in the valuations that we accord to these opportunities, to not lose our capital even if we go wrong, right? So this is our overall approach. We tend to buy companies which many times are not really known in the street, right? Because they're still sort of hidden under the radar. Many mutual funds, FII, etc., they still are not yet invested in that company yet, right? You don't have necessarily brokerages covering them. So we need to go that extra mile to cover and understand this company a bit in a more nuanced way so that we can ride that journey along with them, right? The other thing I think what Shyam also articulated is that equity as a class is obviously has its own boom and bust cycle. And small caps as a subset of that has its own cycle, which is perhaps even more amplified, right? So in that context, it is extremely important to have something to anchor yourself on, right? All of us have had a great 2021, and right after COVID, the markets have been on a runaway party, right, for the last almost 18 odd months. But it is not always that. So you will know that there will be a time when the waters get choppy, there will be turbulent times. So you need to be able to ride or navigate those tough times. And that is where process comes, that is where philosophy comes, and that is where your investing framework comes, and that is where the topic comes, that how do you build this conviction, or how do you go about building this conviction, right? So if you go to the next slide, so really, what is conviction, right? I'm sure all of us in our day-to-day life have used this word. So dictionary defines it as something which one has a very strong opinion or strong belief on, right? Which all of us would sort of agree. But in the context of investing, we've just modified it in a slightly different way. So investing is not a deterministic game. You're playing the games of odds. You're playing the games of probability. You are taking a bet that this company should do well, and you are trying to come to that decision by going through a journey of your own to answer this question. Anything that you do to enable you to answer this question in a way that you can maximize your upside, but at the same time you are minimizing your downside, right? This process that you do, this journey that you have, is called, what we call as conviction in the context of investing, right? So how do you go about building this conviction, right? So we can move to the next slide. So everybody starts with a very high level view. Let's say somebody tells us about a company, numbers are good about for this company, or we've heard that this company is doing great. We start with that high level view. And then to come to a view whether to come to an investing decision that we want to invest or not, we go through a set of steps or efforts, that journey. That is what we will focus on. So the end outcome is conviction, but the journey that we go through, right, which is time consuming, which takes effort, which is iterative, you keep on doing this, right? That is what we focus on. So process is what we will focus on, and we will probably highlight a couple of cases also. So this process is what will lead to conviction. So what is this process? So we deal with public markets. So public companies, the first thing that we can do is go through the journey of a company, right? If you go through public companies have to compulsorily submit their annual reports, quarterly filings every quarter, right? Reading those publicly available documents gives you a view of what has the picture been for that company over an economic cycle, say, let's say 7-10 years. You understand what is the journey of that company. Let's say today there's a company which comes out and says that I'm going to double my turnover in next 3 years. You are excited? Yes, wonderful. That's phenomenal, right? But you step back, you go back and see, okay, this company also said the same thing 5 years back. Have they achieved it? Perhaps not. So what is the credence that I will give now that they are saying that I'll double my turnover in next 3-4 years, right? So that gives a very good context. Then you look at the entire value chain you're studying a company, you look at the entire value chain. Who are the customers? Who are they supplying to? Who are its peers? Who they buy their raw material from, or their other things from? Is this company one of the few companies that the customers are dependent on? That means that really that there would be a lot of bargaining power that this company has. Then we do a lot of on-ground research to understand more about the company, to understand what Shyam was talking about, whether the inflection point of this company is near or not. I'll give you an example here. There was one company that we were analyzing, and we were able to speak to an employee of the largest client of this company. When we spoke to this employee, we were able to glean a lot of differential insights. We were worried how will this company compete in an area where a lot of MNCs were. But what we understood was that this company itself was moving away from the MNCs and giving this company, which is an Indian company, more and more orders. Why was that? Because they were able to customize much better to this company's needs. They were much more cheaper. Closer to India, they were able to fulfill a shorter lead times, whereas the European counterparts had to import a lot of stuff. So this company, this largest client there was a reason why this company was the largest client for the company that we were studying. So you get so much of differential insights, and we were able to come to our conclusion much more faster because of this conversation. Then a lot of work that we do is on forensic accounting. A lot of questions that we get from people who are not in the markets is, how do you really know that the number that these companies are throwing is real, right? And it's a legitimate question, right? So going deeper into the reported numbers, right? Getting to understand what are the red flags, what are the potential red flags, that is something that we spend a lot of time on. For example, there is a company which shows, but to check, let's say, for example, that a company is paying taxes or not. You have a tax line that gets reported in the profit and loss statement, and you have a tax line that gets reported in cash flow statements, to really see whether those things are in line, right? Whether the sales growth is in line, is in line with the cash flow growth, whether the receivables are going faster than sales. So all these things are, again, we tell you to whether there are any red flags or not, again, which will help us to build the confidence on whether to bet on this company or not. We do a lot of study on companies which are in similar businesses but in different geographies. For example, we have a lot of internet businesses now, right? If you look at probably India is a few years behind in terms of the evolution of these businesses. So if you study some of these businesses which have are in the maturity curve, higher in the maturity curve, let's say in the US or Western geographies, then probably you can develop patterns that probably if this company is also following similar path, and if my thesis is right, then probably the numbers that they are coming right now, probably it will be, they are not the real numbers. The true numbers will come probably 3, 4, 5 years down the line if this similar pattern also emerges. Similarly, we spend a lot of time on trying to evaluate the promoters, trying to get an understanding the journey of the promoter, what actions in the past that they have taken in the context of the economic environment, and also really are they going to be a fair partner to us as minority. We don't have any say in the decision making, but in the past, have they been fair with us in terms of sharing the fruits of the profits, the dividends, all those things. And as you develop this thesis, right? I mean, you have a thesis, let's say that this company in the next 4 or 5 years will do something, and this is your broad thesis that you develop. This is the process that you go through, right? Maybe next 1, 2, 3 quarters may not be what you planned, right? So immediately changing that view is not something that we do, right? So that's why I said this process, this is not one time you do and you forget it. This is a continuous process. You keep doing it at the time of investing, at the time of holding the company, and even after exiting, you continue to track. Maybe things will change. Business is continuously evolving, right? Overall, we follow what is called a checklist-driven approach, right? We focus on what to avoid, right? As I said, leverage, we avoid. Faulty promoter governance, we avoid. Poor business economics, we avoid. This checklist-driven approach really helps us to answer these questions very objectively. So over a period of time, we have checklists for corporate governance, quality of the business, promoter management actions. So we follow that, and in an objective way, we come to an answer. As I said again, this process is what we swear by, right? This process is what we focus on, and that will help us to really improve our odds of winning when we are in the game of investing. Again, just to reiterate, this is just one aspect, and there are many aspects which we have not put here, but it's a continuous process. It's not just once. So, as I said, this controlling risk or calibrating risk is the ultimate fruit of following a process, right? When you are investing, right, when you start a business, you will never be able to eliminate all the risks. You will have risks, but the right way to do is to calibrate the risk. What can you control, right? So when we follow this process, you are able to minimize the risks. As I said, doing what not to do, right? And then you're only left with the things that you are supposed to do, right? And our entire focus is, as I said, investing is a game of minimizing your losses and maximizing your gains. And it is a game of probability. So following a process really helps you to improve your odds. So we have seen in our experience, as Shyam was explaining also, 2018-19 was a very turbulent time for small caps. And at those times, we've seen the portfolio really withstand because we follow this process. And we've seen this over our journey of public investing also, that when you follow this process, that when really the time is difficult, you are able to really control and navigate your journey. However, as things are, obviously, if you are things will always get choppy and things will always get turbulent. Now I'll hand it over to Rajat and he'll talk about how we handled it, maybe by giving a couple of examples and what really happens when our conviction is tested. So over to you, Rajat.
Well, thank you so much, Rohit. Good morning, everybody. So Rohit very beautifully explained and took us through why a process is important and what all needs to go into the process to ensure that we are able to minimize our mistakes and maximize on the opportunities that present itself to us. So the thing is, following a process may still not mean that you will end up on the right side always. There will still be, see, investing is all about future, and future nobody can predict. So there will inevitably be scenarios where we will, we will be challenged in our thesis. So, we'll just take you through some of those scenarios and then take you through how we actually have been able to manage them in our real experience. So see, one could be business going through a bad phase after you have invested in that. So you need to really be able to distill that whether that underperformance, whether that bad phase is permanent or temporary. Then once you have invested, the other could be once you have invested in a business and then that business is going through a good time, your thesis is playing out. However, then comes certain corporate action which really puts you off, or let's say which is not in line with what your expectations of the business are. And then again, you have to go back to the blackboard and reevaluate. Then moving on, the other kind of risk or the scenarios that can play out is everything is going fine in your investment. However, market is not appreciating it, which essentially means the share price is not moving as per the fundamentals of the business. So that is another challenge that you face. And the other could be external shocks, which are completely external to the business that you are invested in. However, directly or indirectly, they will either affect the business or the share price of that company. One example of that is COVID that happened to all of us. So that was one big external shock. So moving on to the next slide, we will now take you through two examples. So these two companies that we will now talk about, we had invested in them in our portfolios. So this first example is TD Powers. So this company is into capital goods. They make capital, some equipment which goes into power plants. Back in 2011, this company came out with IPO. And right after the IPO, the capital goods cycle turned for the bad. Capex investments in the country stopped happening, or let me put it, the pace of that came down pretty drastically. So every capital goods company in the industry in the country was struggling, and TD Power was no exception. However, to the credit to the credit of the management, that when we started evaluating this company in 2015, what we noticed that between 2011 to 2015, a lot had changed. So this company used to be a one product, one geography company. They were only selling their products in India at the time of the IPO. However, in 2015, they had launched multiple products. They had found new applications for the same products. So they had found new customers. And now they were selling not just in India, they were selling in export markets as well. Export market, cracking that market in this product is not easy. There are biggies, there are multi-billion-dollar companies operating in the market. However, all credits to the management that they were able to crack it. And actually by 2015, exports became their largest contributor versus domestic, which used to be 100%. So this was the change that we witnessed for the first time at the time of our evaluation. At the same time, the other thing that we noticed was management was able to bring all these changes without hurting the balance sheet. So despite having gone through a very bad phase of 5 years from 2011 to 2015, balance sheet was intact. They were having cash on the books, and probably that's the reason they were able to survive beautifully. And in fact, as we will see, they in fact thrived afterwards. So there was cash on the books, and the other interesting aspect was that at that point in time, the capacity utilizations were pretty pathetic, and they were operating at 50%, which essentially meant when they will grow, incremental returns will be far higher. So simply because of operating leverage, and that is what happens when you attain a scale. Your incremental profits are higher than your incremental sales. So with all these things, eventually in 2018, so we took 3 good years to understand the company. In this case, we went through all the quarterly con calls diligently, and we met the management during this time couple of times to understand the business in a better way. So finally in 2018, we were able to take a call that let's invest in this company. And as you can see, from 2018 to 2020, top line grew and profits grew even faster, exactly because of operating leverage. So profits went up 4 times in a matter of 2 years. However, here comes the googly. Despite everything going well, share price, as you can see, from 2018 to 2020 was flat. And this time period does not include the COVID correction. So here is one company which is doing perfectly fine. Its profits are going up, its outlook is becoming even more positive, but share price is not going anywhere. And then comes COVID correction, which means your stock price goes down by another 50% in a matter of a month. Now what do you do? So on the one side, your process, your framework, your analysis is telling you that this company is good and outlook is good, so you should do well. And you have seen that during the tough times, right from 2012 to 2020, company has been able to manage very well. And now for the first time, outlook is improving for the capital goods cycle as well. So this company should ideally do well, but market is giving you different signals. Market is saying this company is no good, because for the last 3 years, despite the fundamentals improving, share price hasn't gone anywhere. So we went back to our, evaluation and really found out that nothing was wrong with the company. But eventually what was really happening was, share price was moving in a different direction and fundamentals were moving in a different direction. So that's where, we need to separate the two. That's what we learned here, that, our business, actually investing is a business of separation. You need to separate price from the fundamentals. Fundamentals, as long as they are doing fine, price will act as a slave over a long period of time and will follow the profit growth of the company. And as you can see, over the last probably 18 months, so ensuing 18 months after COVID correction of 2020, as you can see, price went up around 6 times, and profits continued to improve, and profit almost doubled in 2021. So during this whole time when the price was down and went further down in COVID correction and performance kept on improving, what we did was we not only stayed put, we in fact invested more money into the same company, and we made this our biggest position. Now, there was a company which we started tracking from 2015. Now we are in 2020. It's been 5 years. We are tracking this company very closely. Performance has improved. Share price has come down. So there was all the good reasons for us to buy more, because we were getting the same company at a very big discount, despite the improved outlook. So we made this our biggest position, and this is how we navigated through, a challenging situation of 3 odd years in this company. Moving on to the next example, Aegis Logistics. This company is into the LPG transportation and storage business. So the reasons we invested in this company was that this business had gone through a big transformation over the last 7-8 years. We invested in this company in early 2021. over the last, so starting 2014 and 15, one can see the transformation taking place. And now the situation was that this company was again debt free, in line with our framework. And this company was gaining market share year on year in its LPG transportation business. And in the private side, this was the largest company. Although this space is dominated by public sector companies, but in the private side, this was the largest company and gaining even more market share because public sector companies were not really focused on this business. And this company saw this as a opportunity and started, investing more and, became more aggressive. And the recent capex that they did to enhance the capacity of the operations and all, so they, the outcome was that they invested some 300 or 400 crores, and they were able to make as much money at the full utilization levels in just 1 year. So return on capital was fantastic. So everything just checked out, and we invested in this company. But what happened within 1 year of our investment was that this company announced a corporate action wherein they were getting into a JV, wherein the majority of the current business will become part of the JV. So we evaluated that JV deal, the contours of that. We did a Q&A with the management. It's out there in the public. It's published on the BSE's website on the company's page. One can go through our Q&A that we did. It was on the public forum. So we were not really convinced by what was going to happen to the business. So what we saw was we invested in an asset light company. We thought return on capital, return on investments are great. However, after this JV, things were going to change. So our analysis told us that this is something that will make the business more uncertain. So we should, and this was outside our comfort zone. So despite being in profits at the time of this analysis, we took a call that we should get out. So, within 1 year, we had to get out. So what we did was essentially, went back to our blackboard and, figured out whether we understand this thing or not, whether this is good for the company or not, whether this is good for our investment thesis or not. It turned out it was not, so we sold out. So, just to put things in perspective, here is one case where, we are saying, despite 3 years into the holding, a company is down, share price is down 50%, and we did not sell. In fact, we bought more. On the other hand, we are saying that, within 1 year, your company, you develop a conviction that, this company needs to be sold out because there are certain changes, there are certain new information that when you process, you come to a different conclusion. So very two contrasting cases. From the outside, it may seem to, very random decisions. However, they are pretty logical if you go through your process, if you go through your framework. Ultimately, what you have to do is what suits your framework and what makes you comfortable in your position. Because there will inevitably comes time, many times that, companies will go through a time phase when what TD Power went through. So at that point in time, you have to be comfortable. So we sold out. So now summing up everything, essentially what has been discussed so far. So the key pointers that we would like to leave you with are that the first is that since you are investing in a small cap space, so you need to really be sure about what investment decisions you are taking, and you need to do that with conviction. And conviction comes with process. And you have to do that process. You have to do all the things again and again. You have to become good at it. Once you do something in a repeated manner, you eventually become good at it, and it becomes your second nature. So this is something that you have to keep doing, and you have to control the risk. So once you are able to follow your process and able to stick to your framework, that you will not do things which can result to a bad outcome. That's how you minimize the risk. So you can't wish away the risk from the investment profession. It is the inherent nature of the profession, but you have to try to minimize it at all points in time. So you just stick to your framework, and that will ultimately lead to risk control. And when you put everything together, what you eventually achieve is the ultimate objective, which is that in an investment decision, when you are going wrong, try to curtail your losses, and when you get it right, try to make it big. And with that, friends, we will take a pause here. This is the end of our presentation, and we would like to thank each one of you to take out time on this holiday and to listen to us. And with this, back to the moderator to take us to the Q&A session. Thank you so much.
Thank you, Rohit and Rajat. I think we'll be happy to take questions. You can type your questions in the chat window and we'll be happy to answer them. Yeah, I'll take the first question from Nakul. Basically, it's the extension of the same philosophy in a more difficult space. Solitaire does the same thing in a multi-cap space. Here, it's extremely focused on small caps and emerging companies. So we have to do the same thing in a space where the companies are under-researched, where companies don't really disclose as much as a mid-cap company or a large-cap company would do. But the overarching features, what we look for as traits in the businesses are very similar, but the effort to identify those companies, to track them, and to come to a point where we decide to invest in those companies is a little bit more or a lot more intense in VRDDHI than it is in Solitaire. So that is basically the difference. But the broad overarching approach is very, very similar, but the effort and what it takes to find those winners or find opportunities is more intense, I would say that. The next question comes from Deepak. He says, with rising rates and inflation, the flip side of small cap investments, in your view, how small cap investing performed during inflationary times, especially 2009, 12, 13? What is the return compared to Nifty 50? See, the first thing I would like to tell you, honestly, probably I had my best decade as a small cap investor between 2010 and 2020. I have never compared the returns of the Nifty 50. I've never had to compare, because if you are focused on what you're doing, you will be very far away from the Nifty 50, both in your investing and in your returns. But inflationary times and when interest rates rise, the entire space of smaller companies tends to enjoy a slightly lower valuation than they do in times like we've seen in the last few years, right? In the last few years, in my opinion, a lot of small cap valuations are also a function of liquidity, interest rates, and low inflation. So the profitability also tended to be slightly higher. They trended also higher, and that naturally reflected in market cap expansion and multiple expansion, because people try to believe that this is sustainable over a longer period of time. Whenever you get evidence that it is not as sustainable, then individual companies or industries will slowly start getting derated. The PE multiples will start slowly going down. And when institutional investors lose faith, then it starts going down faster. And when they sell and the velocity of selling is very high, that is when these valuations will be very, very low. Typically, this selling can be secular also. You can see institutional selling happening across good businesses, mediocre businesses, and broad business and bad businesses, because what happens is that they want liquidity. In such circumstances, you get your opportunities. So if you look at 2009 or 2012-13, there are two types of opportunities. One is from institutional selling, and the other is simply businesses were so underdiscovered or undiscovered that they were very, very exciting to pursue. So these two things happened then, and they were the reason why the boom happened probably between 2017 and 2021. It has been one long extended party, and we can very well see those times return if inflation is uncontrollable and interest rates rise very fast. Now, I say this despite the fact that we don't invest in businesses with leverage, but even the businesses we invest in can see an impact in valuation because the market sees a space, the entire small cap space as one. It doesn't differentiate between businesses which have leverage and those which don't, and it tends to take a more conservative view when the risks rise. So this is very natural and it is bound to happen if inflationary risks and interest rate hikes happen. So that is broadly the flip side. But I don't see it as a flip side. It is clearly such trends which provide us the opportunity to buy for the next 4 or 5 years, because inflation is something which will eventually be controlled. And when it is controlled, people will see what they saw between 17 and 21 once again. So it's not something that is going to be permanent. Just like these valuations are not permanent, the low valuations we may see in the future will also not be permanent. They will be more transitory. And I see those transitory phases as the intensive phases best suited for investment, because you can build a portfolio which is very robust of businesses which will deliver. Not to forget, some of these companies which we may own during that phase will also see corporate actions, because the corporate actions will also increase when the valuations come down, and that will also give us some returns. It's not as if the entire phase will be marked by low returns, but in some cases we may get exits which contribute to return, and in some cases we may get institutional exits in shares which become opportunity. So we need to look at both these things, and we need to do what's best for our investment approach and our product. That is what we need to do. It's portfolio specific. So that's my view on rising interest rates and inflation. Is there a way you may allow moving some money 80-20? No, I don't think regulation allows such things, and we will simply abide by the minimum criteria of 50 lakhs in every scheme. We don't want to take a view that it is possible to take a consolidated thing, which I think will not pass the test of regulation, though I know some people do take such views. We are not inclined to really test regulation. We should test our investment skills, not these things. I think that's the best approach to take. So we would prefer you to take an individual investment decision and put money independently into VRDDI. That's my answer to you, Narendra. How is the investment deployed in terms of period? Rohit, I'll let you answer that question. Question from Mr. Prem Kumar.
Yeah, sure. So thanks for that question, Mr. Prem. So essentially, we take a very, as I said, very calibrated and a very measured way of deploying capital. We don't have a model portfolio approach. We take our time to build a portfolio. So today, let's say if somebody who gave us money back in May 2021 when we started, over a period of time, so we didn't deploy all the money at that point of time. We took our time, and probably we are invested around 85-90% at this point of time. So we still have some cash. So it will take some time for us to deploy that capital, and we will not be rushing into. Many people follow a model portfolio approach that you give money and they buy all the stocks that are there in the other portfolio. We don't do that. We feel that every portfolio has to be built bottom up, and it has to respect the market context that is there. So we follow that approach. We take a very calibrated, measured view. If tomorrow there is a very big correction and we have and few accounts start, we'll be very aggressive. But at this point of time, we are very measured.
Yeah. There's another question. In the historic past, what has been the level of recurring investments for VRDDI? 50 lakhs one time, but what has been a realistic recurring investment size and time frame frequency? See, any PMS portfolio, and I have also put a video on this, how a one-time thing will not work in my community YouTube channel, ithought Wealth. You can have a look at that video. It's 5-6 minutes, which will give you a clear insight of how you can manage that. But let me summarize. Broadly, I think that if you really want a PMS to work for you, you must be willing to invest something between 20 and 40% of this 50 lakhs every year. You must put in, let's say, something between 10 and 20 lakhs. And what will this money do? This money will seek opportunity whenever it presents before us. Let's say when the market is down and we have an idea, even a 3-4% bet on a stock can make a massive difference in that portfolio. Let me give you an example. Some of the stocks which we saw in 2020 during that crash turned out to be multi-baggers in just 1.5 years, which is unbelievable, right? You buy it because you're convinced it's cheap, but then it becomes really expensive within a very short burst of time when the market sees the stock the way it should be seen, and in fact sees it even more attractive light. So the frequency of investment should help you participate when the market is giving such opportunities. So continuing investment is very critical to the success of every PMS scheme that you participate in, all the more in a small cap scheme. You must invest regularly, and you must be able to put one lump sum of, let's say, 10% when the markets really fall. So that is very, very critical. And if you do that, then you're basically ensuring the success of your portfolio, because you're going to buy some things when the valuations are really in your favor. That's my answer to Lakshmanan's question. What is the cost of this product time horizon? Rajat, do you want to answer that?
Sorry, what's the question? I couldn't see it.
Shirish, what's the cost and time horizon? If I invest today, what is the time horizon I must wait for?
So time horizon, typically we would expect somebody coming in to, in fact, not just small caps. In general, we feel investing in equities can be very volatile. So somebody coming in, investing in equities should have a minimum time horizon of 3 years. Higher the better. Same we expect for Vridhi, that you should come up with at least 3 years of time horizon with you. In fact, somebody had a question in the chat box that their expenses are 2 years out. We would not advise somebody like that to invest in equities, because you have no idea what will happen when you really need the money. So yeah, that's how we look at it. Higher the better, but at least minimum 3-4 years.
Rohit, I'll throw the next question at you. How are technology risks assessed? How about interaction with external auditors to find ground realities? You can talk about that.
Right. So we do speak to bankers, auditors, as I said, in the ecosystem, to really understand, to really generate differential insights and more about what is happening in the company, in the business, how are the people running the business. So we do that. In terms of technology risks, so every company or every business will have to be juxtaposed against the technology risk that it faces. So it has, I mean, all companies in a way are having some sort of a technology issue or technology risk or opportunity as they will in their business ecosystem. I can give you an example. For example, TD Power, right? They were focusing on generators for thermal power plants. As Rajat was explaining, it was one product. And when we started looking at this business, the consistent view was that this is a dying industry and this will not be there for the next few years, which is a fair call. But what did this company do to mitigate that risk? They went into other areas. So as a business, a person who's running a business, he will also take those calls to really change, to respond to these technology risks that are there. And we also, as investors, very well give credence to that. That is that person sleeping on the wheel? Is the company sleeping on the wheel and saying that this is not going to happen, or they are really taking that risk as a real risk and working towards it?
There is a question about would the current downtrend be an opportunity? You would like to know more about it. Rajat, you want to take it?
Yeah, sure. So yes, we believe every downturn in the stock markets is an opportunity. So let's look at, if we just change our perspective of this downside to something similar to what happens during the festive season in the malls. So you get things at discount price of 40%, 50%. I think this is pretty similar to that. You get the same business that you like, that you have understood, that you have conviction about. Now you get it even cheaper. So I think every downfall in the market is an opportunity, and that's probably why the culture of SIP into the PMS come into picture and can really change your return, dramatically.
There's a question which relates to the minimum is 50 lakhs. What do you think is a realistic total fund allocation that individual investors should be ready for such a PMS, say, over a 5-year period? I would think that over a 5-year period, you should invest another 50 lakhs. That would be good enough, because see, over the next 5 years, let's say in one particular year, we would get really good opportunities, and we don't know which year it's going to be. Let's say you put another 15 lakhs in that period, that can really change the outcome of your investment and the overall experience. And that can really be a game changer for you for placing faith in us in a particular product, right? And I'm saying this as a generic statement. If you believe in a product, then in the year when it's really tough, if you put in, let's say, another 15 lakhs, that can really make a big difference. And there's no way you're going to really be unhappy with your investment experience. Most likely that the product will do much better than what you expect from it. That's my answer to Mr. Bate. My next question I'm going to take from Milind. If I'm in a stage in life where all big experience for which I'm investing are 2 years out, I think you had answered that, right? Can you answer that, Rajat, again? If all big expenses for which I'm investing are 2 years out, does it make sense for me to Vriddhi, to invest in Vriddhi, which may have a horizon of a longer period? He says 2 years out, he has to invest in something else. He has to take out. Then does it make sense? That is his question.
Yeah, so this is what I, in fact,
you mentioned it.
In the
Yeah.
previous question as well, that it's so advisable.
There is another question from Mr. Jacob. What is the minimum investment? It's 50 lakhs. There is another question. Will I, as an investor, get a summarized update of the research done on the investee companies for me to know the reason for sustained conviction or change in conviction? Generally not. But if there is a serious reason which has made us dramatically change, then like we are explaining here, we would naturally do it with our investors too. Will you disclose the companies you are investing to the stakeholders in the scheme? The stakeholders get to know it when they see their statements that these companies are there. Yeah, you'll definitely get to know after the investment. Yes. There is a reason behind this disclosure. I want to just, you're all seeking to invest in PMS. There's a basic thing you need to understand. Now, let's assume that we are following this tell-all approach of I am planning to buy this share, I go on television or I go on Twitter and say this share is great, or I extol the virtues of a company. Please appreciate that when I do this, I am actually inflicting a higher cost on you, because when I go and buy for you, the price which I am going to pay to buy the share is going to be higher, right? And that itself will reduce the returns of all the new investors or even the existing investors who put more money. Such communication, which is not in the interest of the investment, is best avoided, in my opinion. As long as we are able to make the investment quietly at a valuation which is favorable to the investor, I think our job is best done. That's the best way we can actually work for you. That's the reason why I have never gone on a television show. Even from the day we applied for PMS, I have not gone on television. Actually, I have stopped completely, because even unwittingly or without having presence of mind, if I name some company, then you give me money the next day. When I buy for you, you are going to incur a higher cost of buying the share, which I think is not fair to you. I think I should be fair to the people who place trust in the process and the product, and eventually whatever we do should be in that area. I'll give you a simple example without naming a stock. Day before and yesterday, we bought stock in a company to the extent of 2% in one of the PMS products. At yesterday's closing, the stock was up 10%, right? So that difference is 0.2% for the new investors. We are waiting to buy. Now, suppose I am going to town talking about the virtues of this company. Definitely there will be 100 or 200 people who will try to buy that stock. For example, if I have 80,000 followers, it's very likely that 1% of them will be tracking the stock and they will want to buy. But what would happen, which I really would not be happy with, is that I would not be able to buy it for my investors. This 0.2% return which I was able to generate is the price we pay for not talking too much about the investments, but it's a profit in the hands of the investor. I think that that price is worth paying in the interest of the investor. So that is why this disclosure thing has to be seen only from the interest of the investor, because it is your cost which we are trying to save by maintaining a lower profile and a more downplayed approach to investing. No, there is no difference. This is only a scheme within ithought. There is no difference in the capital linkage. We have a PMS in which we have multiple schemes. Vriddhi is one of the schemes. Okay, this is an interesting question. As an existing investor in Solitaire, how does investing in Vriddhi add value to my overall investment approach? I will share a personal perspective. Today I have mark to market 12.5 crores in Solitaire, mark to market 9 crores. I don't know about yesterday and today's value, but at the last month, about 9 crores in Vriddhi. So my belief is I pair the two products, and when I get some money, let's say a dividend or some income, I don't really get a grand salary, but when I get some income from some source, I allocate to these portfolios according to the opportunities available. When small cap is trading cheaper and when there are more opportunities in Vriddhi, I allocate to Vriddhi. When Solitaire portfolio has got more opportunity, I allocate to Solitaire. This is the principle we'll apply for every investor. If you are pairing these two portfolios, which I strongly recommend because I am doing it, then what I would come to you is when you have money, we'll tell you which portfolio is more hungry for capital and give the money accordingly. And the decision will be on the merit of the portfolio and what's in your best interest. So this is how we would like you to see the two portfolios. The small cap investing, when it works, will give you higher returns, and there's no doubt about it. Okay, so if you have the two portfolios and you are adding money continuously into both the portfolios, which quite a few people apart from me also do, then what happens is you end up buying stocks when they are in the right valuation in both the portfolios, and you keep scaling both. Let's say the market goes even lower, then you want to take higher risk and your risk appetite suits that, then you can choose to increase your small cap allocation. Let's say the markets are trending higher, then you can choose to invest systematically into the small cap and aggressively into the large cap. These adjustments, these allocations should be done investor specific and done in your best interest, and we'll be happy to do it. This is how I think you should view Vriddhi and Solitaire. Vriddhi does intensely in Solitaire, intensely in small cap what Solitaire does in multi cap. That's what I've already told you during the presentation. I'm just repeating for your benefit. The philosophy is broadly overarchingly the same, but the opportunities in small cap is what we intensely pursue. Do you have any lessons learned in Vriddhi so far? I leave it to Rohit and Rajat to answer. Rohit, you can go for it.
Yeah, no, I think you learn the same lessons every time. It's just being, as we said, the process is very important, and we really saw that the portfolios are very, very resilient. Even as I said, and I think Rajat also mentioned this at the time of his presentation, that between 2018 and 20, the portfolios are extremely resilient, despite being in smaller companies which are supposedly more volatile. I think we just have to stick to that process, and mistakes, reduce the number of mistakes, and even if you make the mistakes, don't make it as a fatal error. So that's pretty much it.
There's another question. Could you share about your learning from failures in this? Any failures that you would like to talk about?
Yeah, so there is, as we said, there are no ways you can not have failures or you can completely avoid failures. I can talk about couple of companies without naming them, where we thought we invested, we thought that there is a business model transition that is happening. The company was very well structured in terms of balance sheet, very good promoters, and they were trying to go from like a services business to a more higher profitability business. And in that transition, they were going acquiring companies because they had a lot of cash. But that transition did not really materialize over the investment period that we were there, about 3+ years, and it is still yet to materialize as we keep continuing tracking that company. So we end up, we didn't make any money. Fortunately, we didn't lose a lot of money because there was a lot of cash. They did a lot of buybacks. We were able to get that money back. All those things happened, but that was something that where the outcome was not desired. And the learning really was that the company was cheap statistically, and we were hoping for that growth to come. That growth didn't happen. That statistically cheap thing only helped us to protect our capital a bit, but really did not give us the money as such. So you really need growth also when you're investing in small caps.
Rajat, I'm going to throw the next one at you. In the context of current market volatility globally, what is your view on the small cap space? Are you seeing good opportunities, or do you still see valuations stretched? That's the question for you from Pratibha.
Sure. Thanks, Pratibha, for the question. The volatility is bound to exist in the equity market, and current times are actually full of volatility. We do see opportunities at this point in time. There are pockets of opportunities in our mind wherein very good companies which we are tracking for some good amount of time have seen some correction during the last couple of months. So we are actively tracking those companies. So there are few sectors, few companies which are expensive, which we are either not interested in, or we are just watching them and tracking them, and waiting for them to come to our valuation range. However, there are some companies which are still available, and as the volatility continues, I think more will come. As we have seen the last couple of months, actually few companies have fallen in our in our buying range. So yes, we continue to see those opportunities, but those opportunities again are a function of volatility. As volatility increases, they will come.
There are two more questions which are very relevant. In your process, do you engage with the entire ecosystem of the business besides promoters? Rajat, you can take that.
Sure. So we try to engage as much as possible. So if you talk about the ecosystem, let's say a company which we are looking at, so they will have suppliers, they will have customers, they will have employees, they will have ex-employees, they will have competition, they will have let's say companies in the value chain which are not related to the company but are part of the value chain. Somebody who is a supplier to the company we can speak to their competition. Then there are bankers, then there are ex or current auditors. So yes, we try as much as possible. You try to get as much insight as is possible, but it is not always that you will get through all of them. So depending on the company, the product, the nature of the business, all these things will differ. And will depending on those situations, we will have some access or the other. LinkedIn has proved to be a very good resource for us in this journey. We have been able to connect with a lot of ex-employees and current employees of many of our companies that we have evaluated in the past, and we continue to use LinkedIn as this resource, and it has worked out pretty fine for us. And we have been able to generate some insight, because what happens in a small cap company, these companies only publish annual reports, and they don't like to publish a lot information in that. So you have to go after the ecosystem and understand the company.
There's one important question. Rohit, you can take this. Can you throw some light on the current portfolio structure in terms of number of stocks, sector diversification, market cap band, and PTR? What does he mean by PTR? I'm not portfolio turnover. Okay.
Yeah.
Okay.
So yeah, sure. So right now we have about 16-17 stocks in the portfolio that are there. In terms of sectorial, and this number would be ±5 here and there, so probably closer to, I would say, about 25 odd names. But what we focus on is the top 5, top 10. We will be fairly concentrated on that. The top 5, top 10 would be about top 10 would be about 70% because that is where we like to be slightly more concentrated. That is one. Second is in terms of industries. So we are fairly diversified on that aspect. So there is exposure to capital goods, there is exposure to IT, there is exposure to chemicals, there is exposure to financials. So it is fairly diversified. And we focus on having multiple industries because because a lot of industries are going through a lot of tailwinds right now. And in terms of overall concentration, we focus on the top 5, 7, 10 names. That's where we are. Portfolio turnover, I think we have not really had a lot of turnover. As I said, I don't think apart from what Rajat mentioned, I don't think we've really had any sell-offs as such. But it's been a fairly contained and a very tight portfolio. In terms of market cap, again, the range is big. We have market caps from 250, 300 crores to 15,000 crores. I would say the median market cap would be closer to 2,000 crores. I think because the range is so big, it doesn't make sense to quote that range. But just to show that we have some very small companies and we have big companies also. But in terms of range, in terms of median, I think it will be closer to 2,000, 2,500 crores as market cap. More towards small cap than towards mid cap at this point of time.
This is a very interesting question. Sometimes will cross-holding happen in both Solitaire and Vidhi? Do you have a cross-holding now? I don't think so. At the moment, we don't have.
We don't have. We don't have.
But I won't rule it out because it's as long as the liquidity is there in the stock and it does not affect the investors, we will definitely allow cross-holding. It's not our intention to avoid or anything like that. But we don't want any set of investors to be put at a disadvantage based on the liquidity. It should be fair to all investors. That is the answer. Then this is a very interesting question. For the existing investor in the MF, like with our own MF, do you have a roadmap in migrating to PMS? See, broadly, this is how I see MF. MF is very good for somebody to start and go to 50 lakhs, right? It's very good to go to 50 lakhs. Within that, we can give a lot of variety and we can do a lot of risk management and help the investor save and invest continuously across market cycle. There's no good time or bad time to invest in a MF. So that gives you an investment habit, an investment ethic, and a code of investing, which is very, very good for you, which will last you and do good for you over a lifetime. Once you acquire that investment code and you cross that stage of 50 lakhs, and I'm sure that when you cross that at that point, your monthly savings are also going to be high. I believe that you are ready to do bigger things and you should have all the right to choose whatever you want, and we'll be happy to guide you based on what is in your mind, what you want and what suits your best interest. We have no biases whatsoever on any stream of work which we do, and it's all about what you want and how you want to do it. And we will definitely tell you the pros and cons of making a choice. Right. So that is what we would like to do with you. And we definitely want every investor to move from MF to direct investing as they grow. But to go to 50 lakhs, I think MF is a very, very safe vehicle to travel in. It's a very, very safe vehicle to travel in. And once you cross that, you have the size and the risk appetite to do something better. And we are more than happy to offer you. Please be assured that if you are going to follow this milestone based approach to go towards 50 lakhs, you are ready to do bigger things, and we'll be most happy to guide you in what's in your interest. And that's my answer to Pradeep for asking that question. Okay, there's another question. Rajat, you can answer this. What's the PE range of companies we target to invest?
We don't really go by the statistical number as such. You have to see, you have to actually just follow the, I don't want to repeat everything that was discussed. So we just go through our framework wherein, we try to find a company wherein we are looking for a sturdy balance sheet that, this company can withstand. And you're looking for, at the same time, you're looking for very good positive outlook along with the, capable management team. So then your question, then final point of which you have asked, the valuation. So once all these three things are in place, then we would try to reasonably value the company 3 years, 4 years hence at a multiple which we believe this company can comfortably get without getting into very high flying multiples and all. And if we think it still meets our criteria, we will go into that. So we will not like to put a bar to a multiple, because that will, because some companies are different than the others, and some are very good and some are pretty average. So you can't really say that this company or this kind of company or this set of industry or this set of businesses, be it B2B category, be it B2C category, they deserve a certain valuation. Every company is different, so you have to value those company on their own specific merits. Obviously, you take into account the current market context and the valuations that such kind of industries usually get, so that you get some reference and you don't go overboard.
Okay, there is a question on on corporate governance. See, however hard we try, there is always going to be a corporate governance event that will surprise us. And even when he mentioned ages, clearly that was a corporate governance event that surprised us, right? So then we have to just react and immediately move. But one thing which we have over the entire years of work in ithought focused upon is we try to keep investors in the PMS products away from businesses with leverage. That's an overarching thing. All our products, we try to keep them away from businesses in leverage. The only way we have bought leverage businesses is through the MF or ETF route, which is mainly in commodities. Other than that, we have generally avoided buying businesses with leverage, and by doing that, we have tried to keep corporate governance shock to the minimum. Having said that, we have still had corporate governance shocks, like I mentioned in ages, but we took a clean decision to protect the investor, and we implemented it with great discipline over a day and a half, if I'm right. I think even in a day we finished it. Actually, it's not even a day and a half. The next day we acted on it, and we just ensured that without, as much as possible, without disturbing the price too much, we got all our investors out. We were lucky, we managed it, but our approach would be the same if faced with such a situation. But structurally, we try our best not to buy leveraged companies in our products, right? As a philosophy, we don't buy leveraged business, and that's the way we avoid exposing our clients to such risks. That's as simple as that. That's the PMS philosophy. Except in some products there could be banks, but even there we have a very rigid filter system. So we don't buy banks which have higher NPAs, and it's more the just top 2 or 3. It's not nothing beyond that. And the next question is the VRDDHI product tilted towards small cap or mid cap, and how much of this proportion as time pass by? How much will it be? That's the first question. I'll ask Rohit to answer that. The second part I'll answer first. In the decision process of stock selection, what is my participation? See, we have an IC. Every decision is debated every single day, and that's how we run the product, right? This very, very constant engagement. And just to clarify, all our products post-April will be managed by teams, and I will be in the team as one of the team members. That's how it will be. But I will participate, that much you can always be sure, because I like what I do and I'm very much committed to making the team succeed. And we are all one in that. And that is broadly what I would like to say.
On the question around, Shyam, you want to answer the you want
Another
to
question?
answer?
You can answer.
Yeah.
You see the question? Is it
tilted?
tilted?
Yeah. So right now, as I mentioned, it is more tilted towards small cap. We do have some higher allocation towards 1 or 2 mid cap, but in terms of overall allocation, if I see, it is more tilted towards small cap at this point of time. And this is not a formulaic approach. We will see whatever opportunities are there, we will play it accordingly. If we are finding more opportunities in some mid cap, we'll go there. If we are finding more opportunities in small cap, we'll go there. As of today, it's more towards small cap at this point of time.
There is one question from Kesav and Govindarajan, which I think is very important and needs to be answered, because I take investment positions on different things, and many of the times I am not rightly understood. His question is, I have advised retail investors to stay away from small cap during the time in market on YouTube. So as a whole, what is the investment strategy towards various PMS and advice for the ithought investor? Let me explain. First, in our experience in ithought, the maximum money we have made for our clients has been in small caps, and it was between 2012-13 and 2018 January. Post 2018 January, we have been taking a cautious approach because we saw the Indian economy was not growing, it was growing less, and then you had COVID. So we always try to keep investors in a safer zone. That's the first point. The second point on my comments on small cap companies which are made in the public domain. What I have seen is that most of the small cap investing that happened both through the mutual fund route and through the various other platforms like SmallCaps or through various other models has been chasing momentum. So I felt that as a small investor who does not understand how this momentum builds and most importantly breaks, it is better to stay away than to participate. So that is broadly the thing. And I have also not taken our investors in the MFs into small cap in this period, but they have still done decently without taking too much risk. But when valuations moderate and when they become attractive, then small caps are a space which you cannot ignore, because if you're young and you want to really create a lot of wealth, they give you a long runway in businesses which have growth. So you need to participate in them. To also add a flavor to how Vriddhi sits in the middle of my positions on small cap investing, which I have placed in the public domain, please appreciate that this is virtually the first event we are doing. We have launched a product in May and quietly invested in it. Only people who joined it are people who know us well and who, we could just say, why don't you start? Okay. And we are at somewhere around 73, 74 crores today of AUM. And we have decided to talk about it publicly only when we feel that slowly the tide is turning and we can do a lot of discussion and make people know more about us so that they start participating and participate more when valuations come in our favor. So that is the context of this meeting itself and why we are now talking about small caps, because we see that we are getting more opportunities. We will get even more opportunities going forward, and it's a good time to start talking to people and engage with you in a conversation which can lead to your participating in small cap investing gainfully over the next 5 years. So this is a good time to start that conversation, and hence we are here in this meeting. So that's my answer to Kesavan. Rohit, you should take this. What's your view on PSUs? Is this an area you would consider in Vriddhi? Pratibha has asked a very important question, so I'll leave it to you.
So, I mean, our overall view is anything that we understand and we think that we feel that the risk and reward are interesting, we'll go. So there is nothing like we will not do this or we will not do this. If we don't understand, it may be a PSU, it will be a private company. It'll be the answer will be derived from that approach. Having said that, that space is actually interesting. There is a lot of things that are going underneath the headline that we read that PSUs have not generated wealth, and there are a lot of very solid businesses there. So you need to be discerning. You need to put what is happening in the context of government trying to sell some assets. Some of these assets would be very interesting. So I would say that we are looking at that space and we'll selectively look at that space, and we are focused on creating value. And if we think that the process, the risk reward metrics is in our favor, then we will not shy away from taking a bet.
The next one, I'll ask Rajat to take that. In your decision making, do you take top-down approach or bottom-up? And I'll read that exactly. That is, identify certain themes and sector you feel will do well, and accordingly identify stocks, or is stock selection entirely secular process irrespective of which sector bucket? And the leading question is, which sector in your house view are going to do well in the time to come? So you can answer that.
So Thanks. I think it's Gaurav Sekhar. So thanks, Gaurav, for this question. So we most of the time we will go bottoms up. We will would like to put up a team and then invest in a sector, that sector or the theme across all the companies present, which is what top-down investing does. We like to be bottoms up. However, when you are doing bottoms up, what you do is as part of as Rohit explained, as part of the process, you go through the so you end up reading annual reports or the business outlook of similar other companies, and that's when it might click to you that oh, okay, there's a theme which is emerging. It's not just one company that I like or I'm spending time on. It's the whole sector, or there is something which is emerging in the sector. That's how you may end up uh, countering a theme where you are interested. It's not that we are averse to listening or hearing or reading about the themes. We do understand them and we do know what themes we like and all, but still liking the theme and investing in as a basket is something that doesn't make sense to us. You have to choose the companies bottoms up. So those companies have to go through that rigid criteria of various checklists and processes that you have. This is how, so it's the bottoms up and not the top down. In terms of various themes that we like at this point in time, I think there are many themes which are playing out across sectors. So without getting into any name as such, however, one generic theme that we like as investors is that anything which is trading is available at attractive valuations, because the sector hasn't done well over the last few years because of various reasons. We do like those themes, and I think PSU is one such theme. There could be capital goods, there could be real estate. So broader criteria there to go with, and then find the bottoms up individuals.
There is one question on what you do with idle money because you wait to invest. Rajat, you want to take that?
So
what happens to the money which is idle?
First of all, I would say that money is, believe us, that money is not idle. That money is the dry powder. That money is something that will be most handy when you have the opportunities. Now to answer your question, what do we do with that? We park that capital in the liquid funds, so that we can use that whenever the opportunities come up. We buy liquid Bs.
Well, that's more or less we have come to the end of questions. Gaurav Sekhar again, the last question. So I'll take Gaurav's question last because it's very relevant. See, actually, as a firm, there's much more to ithought than me, and that's not today. That's from day one. So we are a research-driven firm, which means that whatever we do, even in mutual funds, the reason we got into mutual funds is that we didn't want to tell our views in the public domain because it would become extremely controversial. That's why we created a service where we could tell it to a few people who could use our views constructively. And that's how the whole ithought idea itself came into existence. So we are basically a research driven firm. We have multiple teams working in company research, fund research, and these teams play a very, very significant part in our whole process and in every product. And this team approach is overarching. The fact that some of our colleagues have not come out in the public domain and spoken, or they're shy, no way reduces their contribution to what we have done over the last 11 years. And I think it is time that I play their part and they play mine, right? So I have taken the call that that should happen. And if you're a football or a hockey player, I think I'm going to the midfield and more people will come in front and they will play. That's about it. But we are a team and we play as a team in any product. That will be there because we all enjoy what we do and we gel as a team for getting the best for every investor who trusts us. Whether it's with the solitaire or mutual fund or RIA or wherever it is, this is the approach that we have followed. And this will be the approach going forward, where more of us will hold fort and newer people will come and engage with society. And I think that is one of my objectives with which we started, I thought. And I think it's time that the organization shows more people to society than me. I think that's broadly my thought process. And that is why I stopped going on television in 2019. And now I'll probably let more people do the heavy lifting in society. That's my answer to Gaurav. I hope it satisfies Gaurav. Yeah, one last one. I'll let Rohit take it and then we'll close it. How do you handle where management does capital misallocation or unrelated diversification? I think we have discussed this in ages, but you can add a line. And with that, we'll close this session. I want to thank you, and over to Rohit. You can say something on that, and Rajat, you can close with your last comment.
Sure, Shyam, thanks. So, capital misallocation, I mean, I would say we would not really tolerate that. Obviously, everything has to be put in context. Everybody makes mistakes. Like, for example, you asked that intercorporate lending, etc. It has to, I mean, see, it has to be put in the context. Is it, you need to understand the situation first. You need to, before taking conclusions, that's what, like Rajat explained in Aegis' example, we gave the management their fair share of hearing. Then we went back, we understood what it means for us from our perspective in terms of what thesis we had. So you need to give that. But certainly when these things happen, these are not things which you really like, right? And these are a deviation from your route path that you have chosen. So you need to be very careful. And history, if you usually what we've seen is whatever has happened, a company has done in the past, it does repeat. Maybe they change their stripes for a bit, but it eventually comes back to the same thing. So if you are careful in the evaluation itself, then less of these things will happen. But as I said, we will. I don't want to give a very definitive answer because things are very dynamic. But I would say that most of the times, you need to sort of move on and look at other things because opportunities are always there. That's what I would say. Rajat, you want to add anything?
I would just like to add that we would like to err on the side of caution. It is all right to let go of certain returns making opportunities, because what really matters in investing is that you avoid the loss making opportunities. And if you know something beforehand, then you shouldn't do it. So it's better to let the let the clarity come, that why something happened, and you get a clarity on that aspect. And if you are convinced with the management's explanation and management's way of working, then you go ahead. Otherwise, you just sit outside and don't participate. But you continue observing such things, how future developments take place, whether you were wrong or the market or the market was wrong. So you continue observing such things, and then you use this knowledge over the next whatever years that you are gonna spend in investing. Then that's the benefit of being in this profession. Everything compounds, everything accumulates. So you use that knowledge and improve your future decision making. So and with that, this brings us to the close of the webinar today. We would like to thank everybody in our team for putting this up together in a very wonderful way. Thank you, everybody from ithought team, and all thanks to our viewers who took out time on a holiday, that in the morning. So thank you so much. Have a good day.
Thank you, everybody. Thank you so much. Have a good day and a good weekend. Thanks.